Hey guys, today I want to speak to you about how to pay yourself as a limited company director. I want to unpack the most tax efficient salary to pay yourself in the current tax year of 2024-2025. This video is ideal if you are somebody who is either a limited company director already, or you are somebody who is an employee but who also has a side business as a side hustle or as a limited company on the side and earning an income from it. Or you're someone who's actually thinking, do you know what, I'd love to start my own business, but how do I go about paying myself eventually? If you're one of those people in those scenarios, this video is perfect for you. Now, in case you're wondering, who is this guy on the internet talking to me about limited companies? My name is Ken Okorafor. I am a qualified chartered accountant with the Institute of Chartered Accountants in England and Wales. I've been a chartered accountant for 16 years. I've also worked as a finance director across, multi-million pound businesses, as well as a chief financial officer. In addition to that, I'm a business owner by my own self. I've built many businesses, run various businesses, and started many. Plus, I'm a Sunday Times best-selling author. All that to say that I'm not just some random guy on the internet. Everything I share today is coming from my lived experience as well as from my own experiences over time as a professional, okay? But everything I share is also not financial advice to you. So do make sure you check with an accountant, that sort of thing, to just make sure you're making the right decisions for your business. But rest assured, everything has been checked, every I dotted and every T crossed. For today's video, I'm going to break it down into three main parts. This introduction is the beginning part. The second part, I will do a very detailed presentation for you, walking you through all the changes in tax, changes, regulations, national insurance, corporation tax, all the things you need to know. I want to break down the scenarios for you, whether you're paying yourself just a salary or a dividend with a salary or a dividend with salary and pensions and other various scenarios as a potential business owner. So do make sure you buckle up. And if you really love the sound of that, I'd love just one favor. Hit that subscribe button. Right there you see a button. Hit the button. Even if you think you're subscribed, please take a moment. Every single subscriber really does matter for our channel. So please do subscribe. And whilst you're there, please like this video and share it with other people. Now, one final thing. Through my demonstrations on this video, I'm going to be using a very detailed spreadsheet. Many people in previous versions of these videos have always asked me, Ken, can I please download your spreadsheet? If you'd love a copy of that spreadsheet completely for free, I'll put a link to it below and above for you to head over and check it out. Other than that, let's cut straight to my presentation now and get started. Okay guys, here we go. How to pay yourself as a limited company director for 2024-2025. Here is what we're going to do. But before we do that, a quick one to just say, please like and share as well as subscribe if you're really enjoying today's video. Here is the agenda for today. So we're going to first start with corporation tax and look at allowable expenses. Then I want to look at company pensions, then income tax, national insurance, dividends. And then I want to come to director's salary and the most tax efficient income. So make sure you hang around for that. And then I want to do a detailed comparison on Excel, where you can also download my spreadsheet. So we're going to start with corporation tax first. Corporation tax is payable by a company on net profits. Very important after taking into account your business expenses. Now for the year 2024-2025, here are the rates you need to be aware of. You pay 19% for the small profits rate, SPR, for up to £50,000 in profits before tax. And I'll be doing a scenario later at that level for you. And then if you made profits beyond 50k up to 250k, there is a marginal rate that's applied. It's a marginal relief that's applied for you, and you can use a calculator. So over here on the HMRC website, you can see here marginal relief for corporation tax. You can come here and use this tool here to work out what your rate might be in terms of what you might be able to need to pay for corporation tax. And then 25% is what you pay over £250,000 in profits before tax. Now, before you pay corporation tax, you can deduct allowable expenses. The key thing to be aware is that those need to be wholly and exclusively for business purposes in order to reduce, the likely tax that you might need to pay. Here is an example of those expenses. That's the key condition, wholly and exclusively for business purposes. Salaries and national insurance, excluding dividends, so NI and salaries are deductible for tax. Pensions, very, very important. So many people overlook this one. So many business owners actually don't pay themselves a pension, not even realizing it's a tax deductible expense. More on that later. Home office expenses, mobile phones, landlines, and so on. Fuel expenses, all the details are here. Advertising, accountancy fees, and so on. These are deductible from revenue, less expenses to get you to a profit before tax number. Now, carrying on to company pensions, you are allowed up to £60,000 per year per director. So for example, if you have a husband and wife team in a small business, they can pay up to £120,000 into their pension. You can set up a company pension very easily. They're provided by, some of the investment companies that you might already be using. For example, we've got one with Vanguard, for example. You set one up and you can literally transfer money from your business's bank account straight into your pension. They'll first do some checks to make sure you are a legitimate director. They'll do a few checks. Once you're set up, it's an easy connection to pay straight from your business into your pension. And that amount you're paying from an accounting perspective and bookkeeping is then treated as a tax deductible expense. It's literally a credit to a credit bank, that money leaves your bank account, but a debit to as a pension expense from business perspective. So that's what happens there. You pay zero corporation tax as well as employers NI on that amount you pay into your pension. Okay. Now the thing to note is that pension amount paid in from the company must not exceed the company's current year income. Okay. And also, if you've never done this before, you also have the opportunity to backdate some of these pension contributions, I believe by up to 3 years thereabouts, if you already had a pension scheme in existence but didn't get round to doing this. Yeah, so that's pensions covered. Now let's speak to income tax. So here we're speaking specifically to tax on income excluding dividends. So that you earn, i.e. your salary. So you have zero tax to pay on amounts up to £12,570 per year. This is your personal allowance. This has been fixed, in a budget a couple of years ago up to, 5th of April 2028. Effectively a form of, I call it robbery, but effectively a form of fiscal drag. People have been, their thresholds been frozen, which is a very frustrating reality for a lot of people. One thing to note is that you lose £2 for every £1 over £100,000 if you're very fortunate to earn at that level. This means essentially that, if you take that number 12,570 and multiply by 2, it means you're effectively going to be losing all your personal allowances at around the income of £125,140. And the effective tax rate in this window from that 100k to that sort of number is around 60%. So you're paying effectively the highest possible tax rate at that level because you're also losing your personal allowances. Now here are the income tax thresholds to be aware of, for yourself. If you're, paying income tax, you pay nothing, as I said earlier, up to 12,570, 20% between that number and 50,270, key number to be aware of. And then 40% if you go above that, and obviously up to 125,140. And of course, I mentioned earlier, you start losing your personal allowances, and then the additional rate of 45% then kicks in above £125,140. Looking here at national insurance, and this one does go over people's heads a little bit, but I'll try and make it really easy to understand. Now, there are three things in previous videos I've done on this particular topic. Would say this, but not on this third point. I want to just explain. So, what I'm saying here with national insurance is that to get the state pension, it is very, very important. You should pay yourself a salary above what's known as the lower earnings limit. Okay, and I'll show you what that is in a minute. and to pay zero employees NI, which is a big part of why I'm talking about this video, because you can pay yourself tax efficiently without necessarily needing to pay that employees NI. To pay zero employees NI, you should pay yourself a salary below the national insurance primary NI threshold. Yeah. Now, ignore that third point for now. Focus your attention on the first 2 points, because if we then look at the 3 thresholds that are very important here, which are the lower earnings limit, the primary threshold, and secondary threshold, here are the numbers you need to be aware of, because these numbers will play a role in determining how much you need to pay yourself tax efficiently as a director. First is a lower earnings limit for national insurance. This is important for state pension benefits, and the amount, the limit here is £123 per week, or £6,396 per year. Okay. The national insurance primary threshold, this is where, if you exceeded this amount, you would start to pay employees national insurance. This is equivalent to £242 per week, or £12,570 per year. This is exactly the same amount as the current personal allowance, the amount at which you do not pay any income tax in the UK at present. And then the final one threshold to be aware of is the national insurance secondary NI threshold. This relates to employers. This is the employers NI. And beyond this number, your company, not you, your company would start to pay employers national insurance, and it's £175 per week, or £9,100 per year. So you can already see that there are 2 key numbers that jump out, which are primarily 12,570 and 9,100. And I'll be covering these in a bit more detail shortly. But these are the 3 limits you need to be aware of for NI purposes. Now, carrying on with NI, if you earn salary above the NI free threshold that I mentioned earlier, the national insurance primary NI threshold for employees NI would apply. Yeah, so if you earn above this amount, here's the key change you need to be aware of. You would now be paying, so if you earn above 12,570 per year, if you earn above this, you would now pay 8% between 12,571 and £50,270 in a year. That 8% number used to be 12%, if you remember from my previous video, but there have been a number of successive changes, a number of announcements. You might hear of this 2p reduction in NI. This is what this speaks to primarily. It used to be 12%, now it's 10%, then became 10%, sorry, and now it's 8%, okay? If you earn above the 5270 number, there's an additional, there's a 2% that's then charged above that number, okay? So it's banded, 8% up to 5270, and 2% above that number. Now, for employers and NI purposes, it's worth noting that if you earn above the number 9,100 I mentioned here, your employers NI number is basically 13.8%. This is what you are paying. So when you then combine these 2 numbers, and this is the whole point of making a video like this, when you combine these 2 numbers, you see that the 8% plus the 13.8% gives you a total combined hit of 21.8% that you could potentially pay depending on how you choose to earn your money. And the goal being that, we want to try and reduce that as much as possible. Now, speaking to dividends briefly, dividends are paid out of current year profits after, keyword, corporation tax, or primarily from your prior year retained earnings. Retained earnings are on your balance sheet. Yeah. So if you don't have retained earnings and you don't have current year profits, please don't pay yourself a dividend. Yeah. This is payable only to shareholders of a company. There is no national insurance contributions on dividends, which is why you might see people combine paying dividends with paying themselves a salary and so on. And I'll be talking about that later on. A painful change is that the tax-free dividend allowance is now only £500 per year. Used to be a lot higher, used to be 1,000, and used to be a lot higher than that. But again, there's a continual attack on these allowances, and they keep getting reduced every single year. The thing to note about dividends is that dividends any unused personal allowances from your 12,570 per year can then count towards dividends that you can pay yourself tax-free. Here's an example of that. If you only paid yourself £8,500 in salary in a year, you would still have £4,070 of personal allowance left, i.e. your 12,570 tax-free less your 8,500 salary you paid yourself. This means that you can now have tax-free dividends of the remainder, £4,070, plus your tax-free annual dividend amount of £500 for the current tax year, giving you 4,570 in this example only. Now, dividend rates differ to typical income tax rates and follow the same thresholds pretty much, but with different rates applied. So dividends have these rates. So if you are earning between that band of actually that number there should be a bit lower, because the tax-free amount is £500 per year. But the basic rate from this dividend perspective is 8.75%. If you earn above that 52.71 up to 125, 140, you're paying a much higher rate of 33.75%, and above that you're paying 39.35%. But the key thing to note is that the basic rate you're paying up to that 52.70 is 8.75%. It's worth noting that dividends, you typically pay the tax later when you do your self-assessment. So it's not like, when you have your PAYE and it's taken out of your salary every single month. You typically do this when you do your self-assessment, and then you pay your dividends later on, okay? Now, moving on, before I go into revealing the actual tax-efficient salary, I just wanted to mention briefly, as I mentioned at the start of the video, we are Sunday Times bestselling authors of this book, titled Financial Joy, a 10-week plan to help you banish debt, grow your money, and unlock financial freedom. This book is going to be game-changing for you if you are an individual trying to grow wealth or build a business or invest. We'll cover all those things across 10 weeks in a lot of detail. So feel free, check it out, order a copy, and if your budget allows it, get a copy for a loved one as well. Available everywhere: Amazon, Waterstones, Audible, and so on. So here is my suggested director's salary for 2024-2025. I'm suggesting that the tax efficient salary to pay yourself is £12,570 per annum, or £1,048 per month. If you paid yourself this salary, you will pay no tax on that money, and it will be the most tax efficient amount to pay yourself in this current tax year of 2024-2025. Now, above this number, I'm suggesting that you pay yourself some dividends, okay? And as I've mentioned earlier, these will attract different tax rates, but follow the same income tax bands as you would if you were earning in your normal day job. Now, why have I suggested you pay yourself £12,570? Let me go into a bit more detail on that. There's a lot going on this page, but just bear with me and I will just explain in detail. Now, I've chosen that amount because it's above the lower earnings limit of 6,396 per year. So you will qualify for the state pension. So there's no question about that. That's a tick. Done. It's that amount, 12,570, is the same as a primary threshold of 12,570 for NI purposes. So there will be no employees NI due for you to pay. Yeah, which is great. Again, another tick. Now, however, that amount of 12,570 is above the secondary threshold from a employer's NI perspective of 9,100. So you will have employer's NI to pay of 13.8% between that 12,570 amount and the 9,100 threshold. And the calculation for that is 3,470 times 13.8%, giving you £479, which you would need to pay out, yeah, from a business perspective. However, it doesn't end there. You get to save corporation tax on the full 12,570 salary that's paid out. Remember, this is a tax deductible expense from a business perspective. And you also get to save on the employer's NI that you're paying out. So I've done a little calculation for you. The total corporation tax saved would be 19%, assuming your profits are below 50k and you're on that small company's tax rate, is 19% times that 3470 saved above here, plus the 479 that you've paid out, which is a tax deductible expense as well. You'll be saving a total of £750 from a corporation tax perspective. However, we need to look at net savings, right? Because if you've saved £750 but you've paid out £479, then your net savings would be £271 in this scenario. Okay. Now, it's worth mentioning this would be higher if you were paying corporation tax at the marginal rate or at the higher rate of 25%. If you're someone who's earning, profits beyond that £250,000 per year. Now, giving all this, you might think to yourself, Ken, I've done all this and all I'm saving is £271. Now, of course, I know, and you will see later, shortly, once I do my other scenarios, every little matters. It does all add up, yeah? Now, you can choose, being really upfront, you can choose between either choosing to pay yourself £9,100 or £12,570. Now, the £9,100 is cleaner and you wouldn't have to deal with all the admin of employers, NIC and all those things. However, if you want the most tax efficient number, it's £12,570 per year as a salary to pay yourself. Now, I should mention that there's the potential of getting employment allowance of up to £5,000 available to offset the employer's NI element if you do claim it. Okay, this is usually available. I can look here on the government website. You can come in and kind of see who is eligible for employers for employment allowance. And if you check here, they give you some information at the bottom on who cannot claim this. It says here you cannot claim it if you are a company with only one employee, paid above class 1 national insurance, and the employee is also a director. So this typically is aimed at, you tend to see this employment allowance given to married couples who are also running the business together and that sort of thing. So that's an option that's potentially available to you. The one thing I want to mention is, remember, if you do go for the 12,570 amount, remember the employer's NIC, you have the option to pay it monthly or quarterly, which is very, very important. Okay. Now, let's now look at the three scenarios I mentioned at £50,000 profit before tax. This is assuming that you are somebody who is this is your only income as a director. I know that there are many people in our audience who have income from their day job and income from a side hustle. And because of that, I've thought about you guys. I'll be linking above to another video I've made for you to consider the side hustle tax implications of if you're somebody who is earning from a job as well as from a side hustle or a limited company or a business. So I've done all that in detail for you. So head over there and check that out. But before that, let me cut to the scenarios and let's get through them real quick. Okay, so here are the scenarios. I've got different tabs. Okay, now what you're looking at here, please don't be overwhelmed, is actually really straightforward. And as I mentioned earlier, in the link below, you can download this spreadsheet. These yellow items are inputs, so you can change them to suit the current rates and that sort of thing. Yeah. What we're looking at here is a scenario where this is the first scenario 1, dividends and salary. This is what you want to pay yourself. Imagine you've made £50,000 in profit before tax. You take the 12,570 I mentioned earlier. That's deducted from your profits. That's a tax deductible expense. You need to pay employers NI. In this example, it works out to be £479. That gives us updated profit before tax of 36,951, from which you pay 19% corporation tax at £7,021, leaving you profits after tax of 29,930. Okay, you're then allowed £500 tax-free dividends, and then you're paying yourself this remaining amount of 29,430 as dividends. If you did that, here's a summary on the right for the director. That director will earn 12,570, pay no tax at all. They will have dividends of £500 with no tax at all. The remaining 29,430, they'll pay dividend tax at 8.75%. giving them this total earned amount in the year of 42,500, and from that they will pay dividend taxes. Remember when they do their self-assessment, meaning that they will take home £39,925 to take home. And from a company perspective, they would have made that much in profits, and they'll pay corporation tax and have that much left over in profits after tax. Okay, so you can see, keep an eye, I'm going to do a summary at the end of the three scenarios. That's scenario one, dividends and salary. It's a pretty efficient way to pay yourself. Now, what if you said to yourself, actually, before I do that, let me come down here and show you the comparison of that 12,570 salary versus a 9,100 salary. The reason why paying yourself 12,570 matters is, as I mentioned earlier, it will save you £750 in corporation tax. And then when you pay out that 479, which is that number there in employers NI, you'll be saving yourself £271. Okay. Now, if you went ahead and paid yourself 9,100 instead of 12,570, this is the scenario here. Again, everything's similar except the number is different here. Now, pay attention to take home number. Yeah, the net income after tax in this scenario is 39,678, but in this other scenario, it's 39,925. So paying yourself that 12,570 number actually gives you a bigger take-home pay. Okay, that's the key thing. Now, scenario two is where we look at pensions, and we're also taking out some salary. Okay, in this scenario, again, 50K, I paid myself 12,570 salary, but hey, hang on, because I've paid some salary that's above the employer's threshold, the business has to pay employer's NIC, which leaves me 36,951 to pay into my pension. I've done that, great, tick, I'm ticking the box. Now, look, here's where it gets really magical. This is the director's summary. They've paid themselves that much in salary. They've paid themselves that much in a pension. They are taking home 49,521. The only difference, notice taxes, absolute zero. Why? Because the pension is treated as a tax deductible expense from a company's perspective. That money goes straight into their pension account and will remain and start to compound and grow if they invest that money wisely. If you want to learn how to invest, check out our investing playlist here on YouTube where we cover a lot. This person's taking home 99.04% of their profit before tax in this scenario, worth pointing out. And of course, worth mentioning that with a pension, you can't access that money until retirement. Okay, so this will not always work out for everybody. I'm doing this to show you the scenarios. Please choose the scenario that suits your personal circumstances. Then the final scenario is scenario three, where you're saying, do you know what, Ken? I don't want to deal with all this dividend stuff. I don't want to deal with pensions. I just want to take a salary. Well, that will be a pretty expensive option. Why? Let's say you made your 50K. Now, you can't just pay yourself all the 50K because you will have employers NI to pay. So you need to factor that into the calculation. In this case, it's 4960, leaving me 45,040 to pay myself as a salary. Once I've paid myself out that, this is my summary here. So 12,570 with no taxes, 32, the remainder, 32,470, when you add them together, gives me that 45 number, 45,040 as my total earned. But because you paid yourself a salary, you got employees NI, at 8%, 2,598 to pay. And then, of course, you pay tax on the salary as a basic rate taxpayer of 6,494, giving you this total income after tax of 35,948, only taking home 71.9% of that profit before tax number. Here is a comparison, guys, in summary. Okay, in summary, here is scenario one. In this scenario, you're taking home £39,925. This is the dividend and salary scenario. However, a better scenario than that is just pensions. You're just putting all your money in pensions. You're taking a bit of salary, but you're putting all of it in pensions. Now, you're better off by £9,596. Now, this will not suit everybody, obviously, but it will suit some people. And I'm just showing you it so you can see the power of putting money into your pensions. However, if you went for the salary only scenario, you're going to be worse off by £3,977 compared to the dividends and salary scenario. Guys, I really hope you loved that video today on how to pay yourself tax efficiently as a limited company director. As ever, we make these videos to empower you as a business owner, as an entrepreneur, or as a would-be business owner. The goal is to help you gain more confidence so you can run your business more tax efficiently and over time keep more of your own money and improve your personal wealth and your personal life more generally. If you've got any questions whatsoever, I'll be here right as soon as you finish watching this video. Feel free to drop a comment. There's no question that's stupid or too simple. Please drop a comment, and as ever, we'll be here to come back to you just after this video, as well as into the future for the people who are going to be watching this video many months down the line. Thank you guys so much for watching today's video, and as always, in all things, be thankful and seek joy. Take care and bye for now.